Welcome to Podkey Daily News, your fast brief on tariffs, conflict risk, and political squeeze points. Three pressure fronts are moving at once. The US and Iran are trading blows, global trade barriers are widening, and new governments on both sides of the Atlantic are running into hard limits. The practical story is cost, supply, and how much room policymakers really have left. The sharpest escalation is in the US-Iran fight. U.S. strikes on Iran have been followed by Iranian attacks on U.S. forces and bases across the region, and the toll is rising. Recent reporting says 3 U.S. service members were just killed, with roughly 17 American dead and about 430 wounded since the conflict began in late February. Iranian sources claim far higher losses on their side, around 3,000 killed and roughly 27,000 wounded, including a heavy civilian toll. The numbers diverge, but the core point is clear. This is no longer a contained exchange. Why it matters beyond the battlefield is oil. The Houthis say they could blockade Saudi routes and shut the Bab el-Mandeb, while Iran has threatened tanker traffic through the Strait of Hormuz. Those are two of the most important energy choke points in the world. If either one is seriously disrupted, oil prices move fast, shipping gets rerouted, and fuel costs climb almost immediately. Markets are already reacting. Some reporting has U.S. gasoline above roughly $4 a gallon, and analysts are gaming out Saudi rerouting options, like pushing more exports through Yanbu if Red Sea or Gulf access tightens. What to watch next is whether Washington tries to re-establish deterrence without widening the war, and whether tanker attacks or insurance costs start disrupting actual flows instead of just spooking markets. The other major global cost story is tariffs. The administration is preparing broad new rounds that would hit imports from more than 80 countries over alleged forced labor compliance failures, then a second tranche covering more than 40 countries for subsidies, currency practices, and other trade grievances. On top of that, President Trump has announced very large tariffs on Canada, reported at 50% on many goods, with carve-outs for energy, potash, critical minerals, and fish. The White House case is that this is pro-America industrial policy. Raise the price of foreign goods, push production back onshore, and strengthen wages and manufacturing capacity at home. The constraint is legal as much as economic. After the Supreme Court struck down parts of prior tariff actions, officials are redesigning these measures and leaning on less used trade statutes they think can survive judicial review. That may give some tariffs firmer footing, especially the Canada action, but more court fights are still very likely. On inflation, the administration says tariffs are being blamed for too much. Officials point to 2018 and 2019 when tariffs rose while headline inflation reportedly fell from 2.7% to 1.7%. Critics answer that headline inflation is the wrong lens. New York Fed work and other studies say tariffs did push up prices in affected goods and added to core goods inflation even if they were not the sole driver of broader price pressure. For households, that distinction matters less than the bill at checkout. Polling shows many Americans connect tariffs to cost of living, and that creates a political risk if short-term price pain arrives before any wage or factory gains become visible. The bigger strategic point is durability. The sheer number of layered tariffs now being proposed could make them administratively and politically hard for any future administration to unwind, even if the courts narrow some of them. In Britain, Andy Burnham takes office after an extraordinary period of churn, 7 prime ministers in about a decade, with a promise to break the cycle while still keeping parts of Labour's platform intact. His agenda is interventionist and region-focused. Use state procurement to support domestic industry, especially defense manufacturing, devolve power and money away from London, and expand public control over services like water and energy. The problem is the fiscal backdrop. Chancellor John Healey inherits much tighter headroom than earlier governments had, with the buffer reportedly shrinking from about £23 billion to something far more constrained. That means less room for big tax cuts, less room for unfunded spending, and more pressure to prioritize defense, which could crowd out other promises. Housing is the clearest test. The government wants roughly 88,000 homes a year, far above recent output reported near 5,000, but planning bottlenecks and weak delivery systems could stop that target long before financing does. There is also a live energy signal to watch: rumors that Burnham may soften the ban on new North Sea oil permits. If that happens, it would show how fast industrial and fiscal pressures can collide with climate commitments. Back in Washington, Congress has one crowded week before the August recess. On the table are a defense spending boost, a stock trading ban for lawmakers, and President Trump's Save America election integrity bill. The math is tight. House Republicans have only about a 2-vote cushion, and in the Senate, the usual 60-vote threshold still makes major partisan legislation hard to move. So the practical read is limited capacity. The highest probability action is whatever can be attached to defense or must-pass vehicles, while the more politically loaded items face a much steeper climb. In tech, investor attention is rotating. Retail traders are buying less of the Magnificent Seven and shifting toward newer AI names like Micron, SK Hynix, and smaller AI plays. That does not mean the giants are suddenly marginal. The Magnificent Seven still make up about 36% of the S&P 500, so retail flows alone will not reweight the index unless bigger institutional money follows. What is driving the reassessment is competition. Alibaba has announced Coin 3.8 Max, and Moonshot AI released the open-source Kimi K3, both pitched as cheaper, more modifiable alternatives to leading Western closed models. Those launches have been strong enough to trigger short-term sell-offs in U.S. tech at times because they challenge the assumption that top-tier AI capability will stay concentrated in a small group of American firms. At the same time, Beijing is consulting on tighter export controls around AI training data and limits affecting foreign chip makers using Chinese designs. That could strengthen state control, but it could also slow Chinese firms at home even while they market models abroad. The thing to watch here is whether open and lower-cost models keep compressing the premium investors assigned to proprietary leaders, especially if regulation starts fragmenting access to chips, data, and deployment markets. One more signal from the security economy. Lockheed Martin has unveiled a lower-cost Patriot variant priced at roughly half the $4 million tag of current models. That matters because conflict-driven demand has exposed a simple problem across allied militaries: interceptor stockpiles run down fast, and replenishment at current prices is slow and expensive. If lower-cost air defense systems can scale, that changes procurement math for countries trying to refill arsenals without blowing through budgets. Those are the developments with the biggest practical impact right now: conflict risk hitting energy, tariffs reshaping costs and trade, and governments running into political and fiscal limits. This has been Podkey Daily News. This episode was generated by Podkey. Create your own at podkey.fm.